Fed is warning about opacity in private credit. Jamie Dimon is warning that when the credit cycle turns, losses could be worse than investors expect. And some market commentary is already asking whether these alarm bells sound a little too much like 2007. So no, this is not a crash tomorrow video, but it is a serious one. Because when most people hear private credit, they think rich people, finance, exclusive, far away, not my problem. That is exactly why this matters. What I want to show you today is not that private markets are automatically toxic. It is that a lot of financial risk did not disappear after 2008. In many cases, it moved into places that look calmer, sound more sophisticated, and are much harder for ordinary people to see clearly. In this video, I'm going to explain three things: what private credit actually is, why this market grew so fast, and why some of the biggest firms on Wall Street are suddenly gating withdrawals, defending valuations, and trying to reassure investors. I'm Amy, and this is Amy's Hidden Ledger. And watch until the end, because the most important question is not just whether private credit is in trouble. It is whether this is just a contained stress event or the first real sign that we are in trouble. So first, what exactly is private credit? At the simplest level, it is lending that happens outside the public bond market and often outside traditional bank balance sheets. Instead of a company issuing a public bond or relying on a syndicated bank loan, a private credit fund steps in and makes the loan directly. That became incredibly attractive after the financial crisis. Banks pulled back from some riskier lending, investors wanted higher yields, and private credit stepped into that gap. Over time, it stopped being a niche side business and became a major part of the US leveraged finance machine. Reuters cited Morgan Stanley saying private credit accounted for about 30% of the US leveraged finance market in 2025, up from 13% a decade earlier. And broader industry estimates now put private credit in the trillions of dollars. That matters because once a market gets that large, it stops being just a specialty product for rich investors. It becomes part of the financial plumbing. It determines who gets financed, who gets refinanced, who gets pushed into distress, and who discovers losses late instead of early. But size alone is not what makes this dangerous. The more important issue is why it can look safer than it really is. In public markets, prices move all day. Stocks, bonds, ETFs. You can see stress almost instantly. Private credit works differently. The loans are illiquid. They do not trade every minute. Valuations rely more on models, appraisals, comparisons, and internal judgments than on a constantly flashing public price. That does not automatically mean the valuations are fake, but it does mean the line can look smoother than the underlying reality. And that smoothness creates one of the most dangerous illusions in finance. People see lower reported volatility and assume lower risk. Those are not the same thing. Jamie Dimon's shareholder letter made exactly this point in more institutional language. He said, private credit lacks strong transparency and rigorous marks, and that weaker standards, weaker covenants, and aggressive assumptions could mean bigger than expected losses when the credit cycle turns. So the real question is not, did the risk disappear? The real question is, how much of the calm is real and how much of it is simply off screen? And once you ask that, the next question becomes obvious. What happens when investors suddenly want liquidity from something that was never truly liquid in the first place? This is where the story gets loud, because the alarm bell is not theoretical anymore. It is already ringing. In March, BlackRock's $26 billion HPS corporate lending fund limited withdrawals after investors asked for about $1.2 billion back in a single quarter, roughly 9.3% of the fund's net asset value. The fund paid out $620 million and hit the standard 5% threshold where managers can restrict further withdrawals. Around the same time, Blackstone's flagship BCRED fund saw redemption requests of 7.9% of shares. Blackstone raised its usual 5% redemption cap to 7%. And Blackstone Plus, its employees, put in $400 million, so all requests could be met. Then came Blue Owl. Investors asked to withdraw 40.7% of one tech-focused fund and 21.9% of a much larger $36 billion fund. Those are extraordinary numbers. Blue Owl said it would fill only 5% of the requests. Its shares hit a new all-time low intraday, and Reuters said the stock had shed nearly half its market value since the start of 2026. A week later, Moody's revised the outlook on Blue Owl credit income to negative and also turned negative on the broader US BDC sector. And this was not just one firm. Reuters reported redemption caps or restrictions across Ares, Apollo, KKR, Morgan Stanley, BlackRock, and others. Before some of these gates even became public, bond investors were already getting nervous. Reuters reported that bonds issued by semi-liquid private credit funds from Oaktree, BlackRock, Blue Owl, Blackstone, and Ares had already weakened sharply, with spreads widening from early February. In other words, the public market was sniffing out stress before some investors fully saw it. And then regulators got louder too. On March 30th, Powell said the Fed was watching private credit closely for connections to the banking system and possible contagion. That is why this chapter should feel different. This is not some people on FinTwit are nervous. This is some of the largest asset managers in the world gating redemptions, some of the biggest listed alternative managers getting punished in public markets, and the Fed asking where the hidden pipes run. So why should a normal household care? Because even if you never bought a private credit fund, that does not mean private credit cannot still reach you. One channel is insurers. Reuters reported that private credit holdings among US life and annuity insurers have more than doubled over the past decade. And one analysis cited there said private credit now accounts for around 35% of total US insurer investments. The worry is not a dramatic 2008. The worry is something slower. Hidden stress showing up through insurer balance sheets, annuity exposures, and retirement security. Another channel is banks. JP Morgan said today that its private credit exposure was about $50 billion, part of a much larger $160 billion exposure to non-bank financial institutions. Powell also said the Fed was explicitly looking for links between private credit and the banking system. And then there is the real economy. Private credit is a major lender to middle market companies. If refinancing gets harder or defaults rise, that can affect jobs, investment, local business conditions, and the broader credit cycle. Reuters cited Morgan Stanley expecting annual private credit defaults of 8% from the second half of 2026 into the first half of next year, led by software stress there. So no, the average person is not secretly holding a private credit fund in their brokerage account, but that does not mean the risk is neatly contained. It just means the connection is indirect. Powell explicitly said the Fed does not currently see the makings of a broader systemic event. Jamie Dimon said private credit probably does not present a systemic risk in the big picture, but that is not the same as saying there is no problem. Dimon also warned that when the credit cycle turns, leveraged lending losses will probably be higher than expected because standards have weakened, marks are less rigorous, and some loans have been sold into structures that deserve more transparency. Reuters also reported concerns around valuations, transparency, lending standards, high-profile bankruptcies, software concentration, and rising redemption pressure across the sector. That is the real message, not everything is fine, and not this definitely blows up tomorrow. The more honest message is, this is a fast-growing, opaque, illiquid credit market showing visible stress for the first time in a way ordinary people can actually see. And the people closest to it are trying very hard to keep the stress framed as manageable. Maybe they are right, but that framing itself is part of the story. So, what are the 3 things to remember from all of this? First, smooth does not always mean safe. If an asset is illiquid and marked infrequently, calm-looking returns can hide real risk. Second, private does not mean contained. Even if you never bought a private credit fund, the stress can still travel through insurers, banks, pensions, and the real economy. Third, when powerful people start reassuring you, pay attention to what they are reassuring you about. That is often where the real pressure is building. That is the real lesson here. Private credit may not be the next systemic crisis, but it is clearly a market where the stress signals are getting louder. And sometimes the most important financial story is not the one everyone is shouting about, it is the one insiders are suddenly trying to explain away. And let me know in the comments what you want me to cover next. Comment A if you want more hidden finance stories. Comment B if you want more practical household money breakdowns.